Hi, good morning, everyone. Welcome to the Manulife Investment Management Regional Investment Conference. In this session, we're going to share with you our global, macro, and Asia outlook. Joining with me is Francis Donald, our Global Chief Economist, and Ronald Chan, our Chief Investment Officer for Asia Equity. I'm Bruno Lee, the Regional Head of Wealth and Distribution Head. So, first of all, 2020 has been a very challenging year for most of the investors. However, it is also quite a rewarding year for some investors. The pandemic has driven the market sell-off, particularly starting from Q2, and create lots of volatility in the market. Most economy has experienced sharp economic slowdown as well as recession. As such, trillions of dollars in stimulus was approved by governments around the world. This measure has resulted in some momentum in the risk asset. So, to look at the situation, we can see from equity market around the world, the global MSCI World has gained over 11%, particularly in the US market has grown over 16%, and Asia, ex-Japan equity index, has also grown by 15%. On the bond side, we also see the bond market has returned about 9% for the investment grade. For the global aggregate bond index has gained over 7.8%, and global high yield and emerging market bond deliver over 5%. Sector-wise, we can see that the information technology and global discretion has been growing and leading the market, and Nasdaq has been growing, by over 30%. Gold also has passed $2,000 mark, the first time in Q3 this year, with accumulating return over 20% year to date. So I'm going to pass our first question to Francis. Hi, Francis. The macroeconomic policy are going through a regime change, as well as fiscal and also monetary policy become increasingly interdependent. So how likely is this policy will succeed in reviving the employment, the growth, and also maintaining the price stability?
Bruno, that is a very well-framed question. You mentioned the concept of regime change, and that is exactly the environment that we're in. The hard truth is that it isn't monetary policy or fiscal policy that is going to bring us back to a pre-COVID norm. What brings us back to the pre-COVID levels of growth is unfortunately just control of the virus. So for the first time, this recession bears the characteristics of a recession driven by the medical outlook and not by the policy outlook. And that's what makes it so complicated to create the forecasts for. But monetary policy and fiscal policy can help mitigate the damage and the destruction on these economies as we wait for the other side. And in this view, what they're most focused on is the concept of the K-shaped recovery. You may have heard of this, but it's an extraordinarily important concept for when we're thinking about what can get back to normal faster and what's stuck behind. If you think about a K, it starts with a long line downwards. That is, every major economy experienced, as you put it, a recession. And then every major economy at least partially bounced back. We're now at a point where segments of global growth are going to continue to reaccelerate higher, and some segments are going to double dip. A lot of people will talk about the K-shaped recovery from the perspective of income inequalities. The better off continue that surge higher, the worse off struggle longer. Those with children who have been implicated by school closures versus those without. But the biggest differential from my point of view is that the part of the global economy that will continue to reaccelerate is the manufacturing side of the economy. It is far less susceptible to developments in the virus. It can continue re-accelerating as global trade comes back online. The part of the global economy that's going to do poorly, that's going to struggle to get back to pre-COVID levels, is the services side of the economy, which we expect to actually, in many major economies, including the United States, double dip and look again like a recession in the future. This is extraordinarily important because it's unprecedented. Every recession up until now in modern history has been manufacturing-led, not services-led. So all of the economic models we would use to help us understand when we're coming out of the recession are not functioning. It's also incredibly important because the stock market is predominantly tied to manufacturing, not to services. So as we are in this environment where the spread between manufacturing and services grows, it's natural that we'll continue to see differentiation between the equity market and the underlying economy. And perhaps most importantly is those economies that are manufacturing based are going to continue to outperform services based. Again, that's a trend change on what we've seen in the past. And in particular, it means that Asia can outperform a lot of the Western world because their economies are going to be less susceptible to this downward move in services. So are we going to pre-COVID? It really depends what sector you're in what region of the world. But unfortunately, a lot of these policies are only going to mitigate that impact as we wait for the other side. And the other side really is contingent on the medical outlook. I hope that answers your question, Bruno.
Right. So, Francis, you mentioned about potential implications on this measure. What about the long-term consequences of this extraordinary policy? And what sort of distortion are you seeing being created in the market?
I love this word that you use, distortion, because it's absolutely how I'm thinking about the investment landscape looking out over the next 5 to 10 years. A lot of people will ask me about what, were big game changers. Are we going to go back to a world where my grandmother actually goes to the grocery store to get her groceries? Are we going to have conferences in person again? I hope so. I would love to see all of you in person. But the biggest trend change to me came from the extraordinary amounts of policy support that we experienced in a really short period of time. In a matter of 6 months, we saw the largest monetary policy stimulus we've ever seen globally and the largest fiscal policy stimulus that we've seen globally. The biggest impact here is that interest rates globally have had back down very low, in the developed world near 0%. And we do not expect any major central bank to be raising interest rates in the next 4 to 5 years. Now, the major implication of that is that global asset managers, global pension funds, global investors are going to continue their incredible search for yield. In a low interest rate environment, we are not getting the same returns that we used to, particularly from government bonds. 25% of the global aggregate Barclays bond index is now giving you a negative return. So as investors, there's very little choice but to move further out the risk curve, to look to areas that are perhaps under-owned that can give you yield. That means emerging markets. It means looking outside of the United States. It means looking deeper into the fixed income space like high yield. And it also means looking more at alternative investments like infrastructure and real estate to try to develop that yield. So to me, the biggest lasting implication of what we've experienced over this time isn't consumer preference shifts. It's a massive change in the policy perspective and the second chapter of an incredible search for yield, which in my view is going to define the investment landscape for at least the next 5 to 10 years.
Okay, thank you, Francis. Now, let me turn the question to Ronald. So, in your view, Ronald, what is the key learning in the Asian market about the COVID-19 situation that we have experienced?
I think this year has been such a dramatic year, has been such a big surprise year. In terms of the scales of the medical issues, the virus, the worldwide lockdown, the policy response that Francis just mentioned has been very, very dramatic from global central bankers. And also, more importantly, the wide swing in equity markets. So I think for investors, this year is really about, it is impossible to predict all these black swan events, but it is possible to prepare yourself to be able to diversify and planning for your investment requirements. And so I guess it is that we need to stay cool and stay invested. And for people who has actually done that in Q1 of this year, which saw the fastest bear market, will be handsomely rewarded in the second half of this year, which you saw the fastest bull market. So stay invested, stay diversified, and most importantly, stay healthy.
I see. So from a portfolio management perspective, do you see more risk or opportunity at the current moment? And do you agree that the ample liquidity available in the market is going to create potentially a overvalued asset pricing?
I think the dramatic market move has actually made certain sector to be overvalued. And these are the sector that has been able to withstand the shock from the COVID. They're like of the healthcare sector, they're like of the IT sector. But having said which, 2020 is about virus and lockdown. 2021 will be about the vaccine and the reopening. Now, with the vaccine that's made available now, is our belief that market will starting to reopen, to renormalize, and with that you will see a sector rotation, which you have not seen in 2020. And so this reopening will means that there will be a much wider opportunity set that's available to a wider set of sectors. So focus on sector rotation, and investors should be able to make alpha from this widening of sector performances.
Right. So Ronald, can you expand a little bit about what support the case for staying invested? You mentioned about stay diversified and stay invested.
Okay. Well, if I put my money in the Hong Kong banks, I get 50 bips. That's cash deposit. If I put money into a 10-year treasury, I get now 90 bips, but after inflation, I got negative return. Most of the European central banks have negative yield. So I'm not making much money from investing into govies. The equity side, as Francis mentioned, central bankers want people to take on risk, and that's why they're doing all this pump-priming with all this excess liquidity being made available. And Asian equity is now currently trading at 30% discount to developed market equities. In the past, has been trading at 20% discount. Our outlook for next year is a globalized recovery, and that means that earnings growth is likely to be in the range of the high teens. So from that perspective, it is the case that we need to stay invested in Asian equities. And you also saw a hard commodity has been going up. So that go along with the themes of a synchronized recoveries. So all in all, I think people need to stay invested, especially for Asian equities.
I see. So maybe I turn the question back to Francis. So Francis, what will be the broad direction of the macroeconomic environment? And is your base case scenario still a stall out period from now until the end of 2021? Particularly, U.S. has now started to use the vaccine.
Yeah, that's right, Bruno. So we have had a three-phase framework when we think about the progression of most economies. Phase one being that initial rapid recovery that drove this ferocious rebound in a lot of data, mostly off of the back of major government stimulus. We then entered what we call phase two, the stall out. This is where we are now and where we've been since about the summer period. And this period is really marked by waiting for the vaccine, that K-shaped recovery, before we can get the vaccine and move forward to phase three. So yes, we are in phase two, the stall out here, a period which we've defined as range-bound markets, some inflationary pressure coming through the system. Now, critically, as we wait for the other side of 2021, we really do believe that this is going to be a year of two halves. The first half of 2021 is very problematic from the macro perspective. A lot of good news priced into the market right now, a lot of expectations that the economy is going to be just fine, but that fiscal stimulus that drove us this far now dropped out, particularly in the United States, less powerful in a lot of other developed markets. So over this period, we are expecting that the economy is going to look very weak on a global basis. Something in the past could have looked like a recession. But here's the thing. Equity markets, just as we're hearing here, are really focused on the longer term, and they know that this is really a distortion in the data. Increasingly, we believe that the market is looking at the next 6 months like it would a natural disaster. Distortions in the data that we will come out the other side of, and it isn't worth trying to make individual investment calls based on this soft patch. It does, however, mean that global central banks are likely to stay extraordinarily easy. They may be adding into this system. They may be trying to be a little bit more dovish, take the edge off the economy in the next 6 months, but we need to keep our eye on the ball. Next 6 months really rocky. The subsequent 6 months and onwards is where we really start to gain momentum and we reach the other side. I completely agree. Stay invested. Don't get distracted by the individual headlines that have come through. A lot of noise, but eye on the ball is really important here.
Right. So sounds like, there are some little bit of a bumpy road before the end of a tunnel. Yeah. So Ronald, so what is the base case scenario for Asia in 2021 in terms of economic growth and also capital flow when compared to the developed market? And please tell us a little bit more about your insight.
So our base case scenario for 2021 is that Asia is going to benefit from the external demand as the Western economy starting to normalize with the vaccine. The number two base case assumption is that the vaccine for Asia will be available, will be made available, will be accessible to at least half of the population by the second half of this year. That means that there will be unwinding of all the border that has been basically locked down. And then the third big assumption is that the U.S. interest rate continues to stay low because of the twin deficit in the U.S. and also potentially, if Biden needs to raise the corporation tax, that will be another move for the U.S. dollar to go further south. In terms of the fund flows, this year we've seen Asia ex-China an outflow of 40 billion. But within China, people have been putting money into China, and that's 20 billion of inflow. And that is really a reflection that China has been able to renormalize much sooner than other countries in the world. And there's also a reflection that there's been a lot of IPO coming into the China space from NASDAQ, and also there's a number of new listings that has been very eye-catching over the last 2 quarters. Our outlook for the fund flows for 2021 continues to be positive for Asia. For EM Asia ex-China, you will see the risk aversion that you saw in 2020 is likely to subside with the vaccine, with the opening up. And also the IPO pipeline that we are seeing from NASDAQ, the returnees of the Chinese company coming back to Asia will continue to accelerate. Right. So from these two angles, we do believe that in the fund flow for 2021 should be seen as a more positive light as compared to 2020.
So Ronald, can you expand a little bit about the North Asia versus the South Asia, and also what particular investment theme that you see being attractive in Asia?
Okay, so for North Asia, obviously the key is China. For China, our GDP growth forecast for 2021 will be about 7.5%. I've seen forecasts which is north of 7.5% from other competitors, but the tilt is on the upside. And China is also a country that has registered positive GDP growth this year, unlike any of other global economies. And then really the key for China is really about the Beijing policy. There are 3 pillars. On the new tech, basically is the tech self-sustainability, the green economy, and then thirdly is really about the dual circulation. Okay, so this would help to regenerate China both from the investment point of view and also from the consumption point of view. On South Asia, the key to watch out for is the vaccine availability and also the unwinding of the barriers of the borders, removal of the borders. And that would help to regenerate the domestic consumption part of the equation. It will help for the travel part of the equations. And so hopefully on the domestic consumption side, that would get a big boost. Now, recently, the ASEAN country with China, with Korea and Japan have signed the RCEP. That means that supply chain relocation will continue to be the theme. In fact, RCEP will further support supply chain relocation. For overseas companies who want to invest into Asia, it is really about China plus one, or in Asia for Asia, that type of concept. And that's the reason why they want to invest into Asia. And then with the RCEP, with the removal of the majority of the tariff, and that would help to prepare that case going forward. In terms of themes, really there are 4 themes that come to my mind. Number 1 is new tech. And we've been talking about tech for quite some time. I think the new tech is really about AI, automation, 5G, cybersecurity, and so on and so forth. More about software into 2021 as opposed to 2020. And I think COVID has actually accelerated the use of technology, like what we're doing right now. And so that will continue to be the case. And that will be applicable for both North Asia as well as for South Asia. The second thing is the search for yield that Michael talked about, Francis also talked about. I mean, if you look at, for Asia, the yield pickup, if you invest into Thailand or Taiwan, the equity yield is about 1.5%. China is about 3%. Indonesia and India is about 6 to 7%. So there's a case to be putting money into this part of the world, especially if we believe that US dollar continues to be soft. The third thing that we are putting a lot of focus on is sustainable investment. Now, China has already made a pledge to be carbon neutral by 2060. And that is also followed by Japan and also followed by Korea. So going into green, going into EV, going into battery supply chain, we have a complete supply chain that's already ready in the North Asia space. And now recently, Indonesia has also come in the picture, given the fact that they have got a lot of the nickel asset. So that will be like the third theme that we're looking for. I think the fourth theme is that after COVID, there will be repercussion to property, especially to commercial property. We've seen a lot of pickup in industrial estates on the back of work from home, on the back of warehousing, on the back of cloud computing. So at the expense of commercial property. Whereas residential prices has been relatively flat at this juncture. So through the investment in REIT, I think people need to be mindful of that sectorial shift on the back of the COVID and on the back of the work from home scenario.
I see. Very clear. Thank you, Ronald, for the fourth theme and also for your analysis on the North and South Asia opportunity. Because the audience are from across the region, I think that will be extremely helpful to understand. So now we are turning into the question and answer period. We got some very good questions from the audience. So the first question that we got is, Francis, what is the long-term inflation outlook for the region, and what is the implication for investors?
Well, generally, we are expecting a pop of inflation into the middle of next year because we have these year-over-year base effects that are coming through. But after that fact, we're going to return to more normalized levels of inflation because the offsetting impacts of inflation are still going to be going up against the deflationary components. So actually, our inflationary outlook is not substantially changed post-COVID than it was pre-COVID. It's just the factors driving it are somewhat different. I will warn you, we are heading into April 2021 where we could have some pretty high inflationary pressures. And that should be something that we need to look through because they're not going to be sustained. They are short-term pop only. And this is why we warn that this yields can pop higher, but it's only temporary in nature. The long-term story is fairly muted inflation and fairly accommodative central banks.
I see. Thank you, Francis. And Ronald, to supplement to that, what about the service sector? So is service economy affecting, for example, the REIT sector? You talk about the commercial property in COVID-19 era, and also, what is the outlook for that in Asia?
Well, as I commented earlier on, I think for the leisure sector, for the tourism sector, obviously has been heavily impacted by COVID-19. We have seen, for example, vacancy rates in Hong Kong office has gone actually double from 4% to 8%. You see a similar picture in Singapore as well. So from the office, related REITs point of view, they have been impacted. Some of them actually are required to cut rent by government policies measures. But at the same time, we've seen a big demand for warehousing, a big demand for industrial estates on the back of the supply chain relocation within Asia. And data center has been long asked for because of cloud computing, as I commented earlier. So again, different segments are seeing different dynamics. Francis talked about the K-shaped recovery. Certainly, it is also applicable to the REIT sector as well.
So even within the REIT sector, there are different subsectors that we can select that can generate potential opportunity during this recovery.
Correct.
Okay. So the next question we got is for both Francis and Ronald. So there has been a lot of change within the international travel, trade, and technology. Can you please maybe share your view on how this industry will evolve in a global context and also Asia context? So Francis, maybe for you first.
Yeah. Sure. So I suspect that we will see a reacceleration back towards pre-COVID levels on a lot of these areas, but it will be regional dependent. We should also be aware that travel is going to change. We're going to see business centers have already decided to shift their main operations to other main cities. We see this in the United States, moving from New York City to Austin, Texas. So when we think about what air travel looks like in the future, we probably need to shift a little bit the kind of areas and the opportunities. I feel this way about real estate as well. In the real estate space, there are opportunities. We should not be blanket negative on corporate real estate, looking for the cities that maybe were not opportunities in the past that are opportunities now.
And Ronald, anything for Asia, for this industry?
So on the travel, I would expect, because of the lesson that we learned from COVID, business travel, unless is really a necessity, I think the medium-term outlook is that it's likely to come off a little bit. Because through the webcam, I mean, you can actually conduct a lot of conversation without having that face-to-face interaction. But for leisure, I think as the border is starting to reopen, there will be a cyclical uptick. In terms of leisure, people have been locked down, locked down in their home for so long, and there's only so much there that you can see within your own city. And there is an urge for people to actually go out, once the vaccines become unavailable. So, talking about inflation, I think there will be ticket prices, especially in the commercial aircraft, that is likely to go up. But business class air ticket, may have some pressure going forward.
Wow. So just to follow up on that, Ronald, you predict that the Asian market would organize themselves around the concept of regionalization rather than globalization. And with the new U.S. administration, what are your expectations for the shape of the Sino-U.S. relation and also enhance the Asia growth, kind of opportunity, the roadmap for the next, let's say, 3 years?
I think the Biden administration, to the Chinese point of view, is more predictable and hopefully more pragmatic. But having said that, they will engage in a more competitive environment rather than a rivalry environment in that regard. And so my sense is that given the fact that they are more predictable, they are unlikely to choose the Trump's route, whereby trade tariffs was really the only measures. So in that regard, the talk will continue to be engaged, but it will be less hostile. And the Chinese will find room for them to maneuver within that set of environment. The another big difference between the Trump administration and the Biden administration is that there is a common value now between the Biden administration and the Chinese administration is on climate change. So there is some common goal that they want to achieve. There's some objective that they would want to negotiate, and then based on that, hopefully there will be more friendlier terms that will come into play.
So you do expect that there will continue to be competition, but there are also there are overlapping opportunities to work together. So they need to, the two sides need to start talking, and put things back to the normal negotiation, kind of a process rather than more extreme, kind of policy. So maybe I think we have 1 or 2 minutes left for the Q&A session. So Francis, I think in 1 minute, can you identify, the key global, economy that will be the best place to invest, and also what asset class or sectors in 2021?
Well, hard to give our whole investment view in 1 minute, but I really do believe that the environment Ronald and I are describing here is very supportive of emerging markets and emerging market Asia. I say that to everybody, not just this audience. We are looking at a low US dollar, one that continues to depreciate, a search for yield that will continue to drive investment flows. We are looking at investment areas that are generally under-owned on a global basis, and that makes emerging market debt in particular one of my most favorite asset classes, not just in the next year, but over the next 5-year horizon as well. I will say that as we're in this environment of a lot of government stimulus, very low interest rates, it does make sense to think a little bit more outside the box than we would have historically. This is why I like some of those alternative assets, things like I mentioned earlier, infrastructure, REITs, thinking a little bit more about hard assets that central banks can't print and governments cannot tax. I think these are going to be things that become more common in 2021. But ultimately, we need to go to places in our portfolio that provide that additional yield, that are under-owned, that benefit from a weaker USD. And that to me just screams to me EM and particularly Asia EM.
Okay, thank you, Francis. And Ronald, any kind of a 30 seconds final recap on Asia opportunity?
Stay invested, stay diversified, and stay healthy. That will be my remarks.
All right, so that ended our sessions for the global macro outlook for 2021. I would like to thank Francis, in Toronto, that are late in the evening. For sharing her view about the global perspective, and also for Ronald to share the Asia insight. I hope all of you will enjoy the rest of the day that we have prepared for you. Just to remind everyone to provide your feedback on the rating of the session, and that can definitely help us to improve and to make sure that the session can help to address your needs for servicing your own investment need or your client's investment need in a opportunistic, kind of a view, but also I think, with continued uncertainty in the market. Okay, thanks again for watching.